In January 2005, the average Canadian home sold for 237,000 Canadian dollars. By early 2026, the average had reached $661,000, a nominal increase of around 179%, or nearly tripling in price. Even adjusted for inflation, the gain is still huge. In the country's largest cities, it's been transformational. Now, there's a common comparison made in conversations about Canadian housing that homes have outperformed the stock market over time. It's worth pausing on this. On a straight price appreciation basis, the TSX Composite Index actually outperformed Canadian housing over the same period, and substantially so once dividends are reinvested. The point is not, therefore, that housing beats stocks. The point is that housing performed like an equity investment in a non-productive asset. A company, when it rises in value, has generally done so by producing something, a product, a service, a patent, a drug, a piece of software. The stock price reflects real economic activity, real production. A house, when it rises in value, has generally done so because land in a desirable location has become scarcer, because planning restrictions have constrained supply, or because a decade of historically low interest rates created a wall of capital seeking somewhere to go. The house didn't invent anything. It didn't employ a research team. It just sat there. This distinction matters because of leverage. If you bought a Toronto home in 2005 for $300,000 with a 20% deposit, so $60,000 down, and that home is now worth around $900,000, your original $60,000 has generated a capital gain of $600,000. That is a 10-to-1 return on the actual cash invested. It's also, in Canada, entirely tax-free if it was your primary residence. If you had instead taken that same $60,000 and put it into a TSX index fund, it would be worth roughly $195,000 today. A solid result, but it gets diluted because of capital gains tax on the profit. The incentive structure this creates is problematic. The rational economic choice for a Canadian household with savings has been for 20 years to put as much money as possible into real estate as early as possible at as high a leverage ratio as your bank will allow. This is not irrational behavior. It's an entirely logical response to the incentives that the system created. It is, after all, how everyone you know made most of their money. The consequences of this are considerable. Housing prices in Canada's major cities now sit at somewhere between 12 and 17 times median household income. The median after-tax income for a Canadian individual in 2023 was $74,000 a year. At the national average price of $661,000, the price-to-income ratio is approximately 9. In Toronto and Vancouver, it's substantially higher. In 2020 and 2021, CIBC estimated that roughly one-third of first-time buyers received a parental gift to fund their down payment. The average amount was 82,000 Canadian dollars, which, as it happens, is slightly more than the median Canadian individual's annual after-tax income. In Vancouver, the average parental gift was 180,000 Canadian dollars. In Toronto, it exceeded $130,000. The Bank of Mom and Dad has in certain Canadian cities become the largest mortgage lender in the country. It doesn't, however, publish accounts. Amusingly, in researching this, I found a Canadian real estate industry publication where the author argued that what Canada's housing market needed was further tax relief for property owners on the grounds that this would stimulate more housing transactions. I don't like to beat up on someone, but consider the environment in which it's being made. The average home in Vancouver costs more than 17 times the average income. The suggested solution is to make property ownership even more tax-advantaged than it already is. This is a bit like a doctor seeing a patient with high blood pressure and suggesting that they eat more salt. Technically, it will do something, it's just not obvious that the something is helpful. The political economy of this situation is almost perfectly paralysed. Approximately 66% of Canadian households own their own homes, meaning that two-thirds of the electorate have a direct financial stake in keeping house prices high. A government that credibly committed to building sufficient new housing to return prices to something resembling affordability would be asking a majority of its voters to accept a substantial reduction in the value of their single largest asset. In Britain, we identified this as the central political obstacle to housing reform. In Canada, the problem is essentially identical. The 2026 World Happiness Report contains a data point that I find genuinely striking. Canada overall ranks 25th, which is a significant fall from 6th a decade ago, but still a respectable position for a country that is, by any objective standard, wealthy, peaceful, and well governed. But when you break this down by age, the picture changes substantially. Canadians over 60 rank in the global top 10 for happiness. Canadians under 25 rank 71st. 71st, below countries with a fraction of Canada's per capita income. That ranking reflects not just where Canada stands, but how fast it has fallen. The World Happiness Report tracks the decline in youth happiness since 2011 across 136 countries. Of those, only 3 recorded a steeper drop than Canada: Malawi, Lebanon, and Afghanistan. One of the 3 has a poverty rate above 70%. One has been in active armed conflict. One is governed by the Taliban. Canada is the 4th. There's a clean explanation for this divergence, and it is the housing market. Older Canadians who bought homes in the 1980s, 1990s, or early 2000s have, through the entirely normal process of sitting in their houses, accumulated wealth that would have been the envy of a successful entrepreneur. The median senior family in Canada holds net assets of approximately 1.1 million Canadian dollars. The median family, where the main earner is under 35, holds approximately $159,000. This is not because young Canadians are less capable, less hardworking, or less disciplined. It's because the asset that generated extraordinary returns for the previous generation is now priced at a level that makes it structurally inaccessible without either a very high income, a parental transfer, or both. Youth unemployment reached 14.7% in late 2025. Approximately 914,000 young Canadians, just under a million, were classified as NEET, not in employment, education, or training. This is the mechanism of generational wealth transfer that the housing market has created. It's not a conspiracy. Nobody designed it this way. It's simply the predictable outcome of a set of policies, planning restrictions, tax treatment of primary residents, mortgage incentives, and low interest rates that happen to be extremely good for people who owned assets 25 years ago and are considerably less good for people trying to acquire assets today. It also, incidentally, explains why the country's most talented young people increasingly look south. Which brings me briefly to Elon Musk. Elon Musk was born in South Africa. At 17, he moved to Canada, where he held citizenship through his mother, and stayed for approximately 2 years before relocating to the United States. He's now variously the world's richest person, the owner of Twitter, which he acquired for $44 billion and renamed X, and a figure of considerable political controversy in the country that eventually kept him. I bring him up not as evidence of Canada's loss, but because of the underlying pattern. Talented individual arrives in Canada, acquires residency, departs for the United States for better economic opportunities. There's nothing really unusual about this story. It is, in fact, the dominant finding of a July 2025 Statistics Canada study on skilled emigration. The study found that roughly 22,000 to 35,000 Canadians move to the United States each year. More striking, about 60% of those applying for US work authorization from Canada are not Canadian born at all. They're skilled immigrants who came to Canada first and subsequently moved on. The median US salary offer for these individuals was $137,000. Primarily in computer, mathematical, and engineering fields. Canada attracted them, educated them in some cases, and then lost them to a market that paid more and taxed less. The Conference Board has called this the leaky bucket problem. Canada has one of the world's most generous immigration systems. It brings in large numbers of highly educated people, but 1 in 5 skilled immigrants leaves within 25 years, with the highest attrition in the first 5 years, precisely when they're the most economically mobile and most likely to be comparing their Canadian prospects to their alternatives. Canada is not, on this evidence, suffering from a brain drain in the classic sense. It's functioning as a very efficient talent incubator for the United States economy, which is a service, I suppose, just not one that Canada intended to provide. Since 1997, Canadian labour productivity has fallen progressively behind that of the United States. The cumulative gap is now approximately 26 percentage points. To put that in terms that I think are more intuitive, for every dollar of output generated by an American worker in an hour, a Canadian worker generates roughly 74 cents. This is not a story about working less. Hours worked per Canadian are broadly comparable to those in the United States. It's a story about where those hours have been directed. The economy has channeled its investment, human, financial, and physical, into sectors that produce lower output per unit of effort. Real estate, public administration, retail, and a financial sector that lends against bricks rather than ideas. Canada's business investment in research and development as a share of GDP has been below the OECD average for 20 consecutive years. The gap between Canadian and American R&D spending per capita is large and widening. A country that doesn't invest in the production of new knowledge or new processes eventually finds that its workers are doing the same things in the same ways as a generation ago, which is roughly